Good afternoon, everyone. Thanks for joining us here today for the April 8th market update. My name is Paul Vendrinsky. I'm the portfolio manager here at SIA Wealth, and today we're joined by Jeremy Fehr, founder of both SIA Wealth and SIA Charts, who's going to go over the market update and look at some charts, some of the stuff we've been following, and then followed by Ted Bader, president of SIA Wealth, who's also going to go over some of the practical approaches for advisors and clients to use some of the SIA methodology and products. I'd like to start off by saying, with the quarter end, we've completed most of our commentaries, and depending on what you might currently own as far as mandates or funds, you should be seeing some stuff on your desk very soon, if not already. The first quarter of 2020 obviously has been a wild one for world markets, and we've seen some major changes in asset flow. And this has had a direct influence to changes within various products that we manage. The year actually started off very strong, if you can remember way back, for equities, particularly in North America. But the outlook deteriorated rapidly, really starting in the middle of February, and of course to the end of the quarter. And of course, this was due to the coronavirus outbreak that grew into this global pandemic. Today, I was going to start off with some brief summaries to the 5 BMO mutual funds that we sub-advise for. And as I mentioned, more detailed reporting is en route, but I thought a quick chat on the holdings for the various funds is definitely warranted. So first of all, the BMO Tactical Global Equity, or usually equity, ETF fund. If you've been to some of our most recent calls over the last few weeks, you would know that after the close of markets on March 12th, the SIA Charts equity action call moved to the red unfavored zone. And according to our rules, we sold all held equities. And after rotating out of these equities, the fund now currently holds, at least this one here, the short-term US bond ETF. That's the ZUS.U. So this gives us exposure to short-term treasuries in the US. As a summary for the quarter, during the quarter, all of the equity holdings in the portfolio saw some losses after a great start, but at the end of the quarter saw some losses. But however, most of those positions did generate strong relative returns, and you can see that looking at the year-to-date performance. And due to actually exiting of all of these equity markets on March 13th, those positions, many of them realized very strong realized gains since their original purchases. The largest relative contributors for the quarter, again, came from technology and healthcare. This has been a long trend in those sectors. And some notable names just to throw out there, the iShares S&P TSX Infotech, that's the XIT, we saw a realized gain of almost 29%. A lot of people don't realize the strength we saw over the last year, and definitely even the start of the quarter into some of the Canadian names in the technology sector. Also, a shout out to the iShares US Medical Device ETF, the IHI. We saw a realized return of 29% since the original purchase. And looking at just a couple of quick individual names, Microsoft saw a gain of 41%, MasterCard 26%. So what we were able to do is cap some of these current gains and move to safety, and we're going to remain there for the time being. Now let's look at the bond fund. With the significant changes in various asset classes, and even within the bond or fixed income asset classes, what we saw mostly happen in March, again, after a great start of the year, what we saw in March was a real shift or a rush out of corporate bonds and into government bonds. And this happened so quickly that to one point, the demand for investment grade bonds almost completely dropped. Default risk grew. This has kind of flattened out and kind of bounced back in the last week or two, but that was a big impact to some of our holdings and some of what we've done. So basically, this combined impact to the economic and market turmoil sparked a quick response from central banks and governments. And what this meant specifically to the BMO Tactical Global Bond Fund was a gradual shift with those market flows away from corporate bonds on both sides of the border toward government names. And this was a big change since we held many of these corporate names for over 3.5 years. Another change within the portfolio that hadn't happened since the inception took place in early January, where our daily review flagged a macroeconomic change. This was on January 9th, resulting in a change of the relative strength rankings of the bond components within the universe. The portfolio at that point moved to overweight Canadian bonds over US bonds. What really triggered this was a weakening US dollar, along with some underwhelming economic data out of Canada in the later half of 2019. And this provided a real boost to the longer duration Canadian bonds, resulting in that shift. However, this was short-lived, as on March 31st, right at the very end of the quarter, we shifted back to overweighting US bonds over Canadians. So what we saw here with the coronavirus and shifts within the market was a strengthening in the US dollar, which provided a boost to those mid and longer term US governments, which we've been moving into, resulting in that shift between the two components. So as a summary right now, we have a targeted 75% weighting into US bonds and 25 Canadian, and mostly treasury based outside of corporates. The quarter did end slightly negative, as you can see, but as a big note, performed relatively well compared to many of our peers, some of which were caught off guard with some of the riskier than anticipated assets within their portfolios. We discussed with a lot of advisors all the time on what they currently hold for fixed income weightings within their portfolios. And I'm not going to point out any specific product names, but a lot of guys started to realize that there was a lot more risk in some of these portfolios than first anticipated. So that's part of the education that we do to try to help people look deeper and get under the hood on some of the stuff they own. Looking next at the BMO Tactical Global Asset Allocation ETF Fund. This is our balanced fund. Since the portfolio is essentially comprised of the two that we just looked at, we saw very similar shifts within it. One unique thing to note, though, on March 6th, the SIA chart's equity action call changed from green favored to the yellow neutral. So following that date, this triggered a shift from, at that time, 40% fixed income to 60%, and lowering the equity exposure that we had to 40% of the portfolio. Then, just like the equity fund on March 13th, when the SIA chart's equity action call moved to the unfavored zone, we sold all of the equity holdings. So now essentially the portfolio has 100% fixed income scattered around a bit. The 40% equity that left went into that same short-term Canadian bond ETF. We saw similar strength within this portfolio as we did on the equity side. Technology and healthcare names were strong as we capped some of the capped and closed those positions. And within the fixed income, again, the same shifts we saw in the bond fund, moving from Canadian and looking at Canadian to US and from corporates to government. Again, more recently, we've seen some underperformance due to the strengthening of the US dollar, since we were heavily exposed to the Canadian bonds, which ultimately helped with this shift back to US. But the holdings individually are where we want to be and doing okay. Now looking at a class favorite, the BMO SIA Focused North American Equity Fund. And again, it's usually equity, right? Again, the equity action call change in mid-March pushed this portfolio to 100% allocation to short-term Canadian bonds, again, the ZST. During the quarter, most of the equity holdings within the portfolio, similar to the equity fund, saw some losses, saw losses for most of the individual positions, but we generated some very strong relative returns due to exiting the markets on March 13th, realized some strong gains also. The largest contributors, again, come from computer software, technology, and even the retail sector. I think we had a position in Costco that did very well up until the day we sold it. So again, we're on the sidelines waiting for things to even out a bit, and in the meantime, remain in the safety of cash. And now, last but not least, the BMO SIA Focused Canadian Equity Fund. Again, the equity action call change in mid-March. This portfolio also went to seeking safety and protection from, really, let's face it, current very violent market swings up and down. Maybe we're building up a strong Sharpe ratio here, we'll see, but 100% allocation right now to that same ultra short-term Canadian bond. The largest relative contributors to this portfolio, similar names. After capping them out, were computer software and technology services names. When we eventually one day go back into the green zone, be very interesting to see what kind of names, if not similar, are at the top of the list. Just to finish things out, here's a snapshot of the various funds and their codes. I just wanted to say, wrapping my part up here, is, this economic and financial volatility may very well continue through the next quarter. Really as sentiment bounces between whether we see more bad news or some good news, what the central banks, what the governments might be doing as far as stimulus, and ultimately the progress toward containing the coronavirus. Through these uncertain times, as always, here at SIA Wealth, we continue to monitor flows. We use the SIA charts equity action call as well as the asset class rankings. We continually rely on our process analyzing money flows and the effect of those flows, ultimately to determine on a risk-adjusted basis where to be. And right now, it's predominantly out of the equity market. Well, it's completely out of the equity markets and will remain so. With that said, I'd like to thank you for joining us today. And I'm going to pass this on to Jeremy for the market update.
Thanks, Paul, and thanks everyone for taking time today. I just wanted to make a note that if you have any questions from what Paul says, I say, and then later Ted, there is you can type in questions through the GoToWebinar control panel. So just fire in those questions and we'll answer them at the end. And if we don't get to your question, we'll answer those to you individually afterwards. First chart I want to look at today is our equity action call. We can see that we're in the red zone. Of note is that we've actually extended further into the red zone over the last week, which may come as a surprise. There have been a couple of rally days in the market, and I'll get to where the mechanics of that come in a few minutes. But again, we remain in the red zone. As Paul just mentioned, we're going to be extremely defensive, removing our equity positions, and risk remains still at a very, very high level. The change in what contributed to the equity action call dropping is that we saw Canadian equity move from the 6th position down to the 7th position. We see commodities move up from the 7th to the 6th position. So this has weakened the equity action call slightly. This was the first change that we'd seen in a couple of weeks, which has been quite unusual for the updates that we've had to do over time. But we do see that change with commodities rallying in some areas. We saw a strong run in crude. We've seen gold move out to higher levels, and I'll look at those two charts in a few minutes. The first chart I want to look at again, same as last week, is our SIA Market Equal Weight Index versus our SIA Cash Equal Weight Index. We can see we're almost at the same level of where we were last week. Where that column of X's ended, just 2 columns to the left of where the current column is where we were sitting last week. We saw a big drop in the markets and then a subsequent rally for a couple of days, and we saw the equal weight index or the equity equal weight index move up versus cash. We still remain in a downtrend. I think this is very important to measure. Even on a short-term basis, one of the things that we watch is that SMAX score still remains a 3, so that hasn't strengthened very dramatically. We would expect that to be a 6 or higher if we were looking at starting to move into even a 1-month or a 2-month trend for us to have faith in it. We haven't even got to that level. So what has happened since we bottomed on the equity versus cash indicator is to be expected. We were extremely oversold. We still look at this as a bear market bounce at this moment in time and not to be treated as a purchasing opportunity just yet. Looking at the chart itself, the SIA Market Equal Weight Index, it actually looks very, very similar to what we saw with the cash, where we had a rally up to the Wednesday of last week, a subsequent decline, and then a short rally back. Not quite up to the levels of last week, just under it. We have resistance above. It did give us a resistance level now, and we've got additional resistance about 4 or 5 boxes above that. So we're watching this closely. Again, we've only retraced about a third of the downside that we've seen in our equal weight benchmark here. That is to be expected. Even as high as 50%, which is the second resistance level, would still be in the context of a bear market as far as looking at this chart on an individual basis. The S&P 500 index, again, it was sitting at exactly the same level on the chart last week. It had a decline and moved back up. It has moved up stronger. So among the indexes, the S&P 500 has certainly been the strongest. It has 40% retracement of its drawdown, so that's more than on an equal weight basis, and material for those who are using this as our benchmark, although we don't use this for our analysis. But we know your clients do. We know that you're likely looking at it. It has resistance now, so where it sits at is very close. We'd be looking at 2728.55 as a level to get us up above the current resistance levels that are just above us. And really the big test will come in that 2895 range is where the big resistance will show up when we look at this chart. But we remain, again, still in bear market status. The bounce that we've seen to date can still only be registered as a potential short squeeze and a bear market bounce at this time. The chart that I think is, the most important and new for the update this week is the Russell 2000 index that I've added here. This is a small cap benchmark for the United States. What we can see here is that it still remains much lower than if you compare it to what we had with the S&P 500. It moved down further in the downturn and is yet to move back. So this is really just trying to analyze if there's there breadth in the market. Are we seeing that the rally that has happened over the last couple of weeks, is that contributing across a lot of different capitalized companies, cap-weighted companies? And we can see that we've only had a small upturn here, didn't retraced under 30% of its downturn. It reversed down even stronger in the recent sell-off and has reversed up at least one box weaker than what we've seen with the S&P 500 and even our equal weight index benchmark. So this is a key part. It's also important to note that this is sitting right on key support. That down or that uptrend line, if broken, we would consider material. And again, just like the charts above, the SMAX score remains weak at a 2. So what's really telling is when we compare those two. So I've got here the Russell 2000 compared to the S&P 500, and I think this chart is quite telling. We look to the left side here, that's going back to the latter part of 2000, moves up into that 2007 range where we've got a strong uptrend for the Russell 2000. The Russell 2000, when it's showing the green arrow here, is outperforming the S&P 500. From 2008 right until the downturn here in early 2020, we can see that the comparison chart between the two goes sideways for the most part. You have trends where small caps are outperforming large caps, and then you have trends where large caps are outperforming small caps. But overall, we've seen benchmarks be tougher to beat, especially over the last few years, and this is one of the reasons why that traditional breadth of the market has not been as defined as it has been historically with the mega caps. Largely through the ETF business has certainly gathered a lot of momentum, and a lot of these mega caps, especially in the tech side, have really become dominant players and increased the value of some of those cap-weighted indexes. But what's really telling is what's happened this year, where you see a strong downtrend in this chart, especially since the downturn recently, where large caps are absolutely obliterating the performance of smaller companies. So the small companies are getting punished more in the market when we've seen the downturn, and they're not recovering, they're not rallying back with the mega caps. This can be explained partially because of the problems probably with COVID and the expected punishment that these companies may have versus some of the mega caps as far as support from federal programs, loans, etc., or wage subsidies for their employees. But it really highlights quite a differential between the large caps and the small caps, and this is something that we would like to see reversing in the other trend, to see more breadth in the market if we're going to see a market bottom and make a call on that. The next chart I want to look at is crude oil. It had an extremely strong rally post our conversation last Wednesday. There was a tweet by President Trump suggesting that there would be concessions made by the Russians and the Saudis, OPEC, that would see production dramatically cut in the 10 to 15 million barrel range. That did not come to fruition, but there was a strong rally that happened as of yet, but the meeting and announcement is potentially coming out for tomorrow. So we'll watch that. Crude, again, commodities rallied up and moved up a bit in our asset class rankings. We see crude at key resistance below that $29 level with range up into that 34, 35. So that might be an expected range for crude to move up to is up into that mid-30s range if there's a positive announcement that comes out of OPEC. And of course, if it's negative, we may see new lows below that $20 range. So we're really watching between $20 and $30 on crude to see which way it's going to go. Right now, it is rallying last time I looked today, but was sitting right in the middle of that range in that sort of $24, $25 range. So we'll watch this closely, see what the results are tomorrow. And if we see move to the upside, that could be beneficial to markets overall. Another chart had a material change from last week, which is gold. It did move above resistance at that 1682.12 level. So we are now through resistance and with a price objective in the low 1800s. So a very positive move for gold. We expect gold to remain reasonably strong based on the technicals of this chart. And again, we position gold as people are moving into it to take aversion to some of the massive amounts of money that governments are going to be issuing in debt and the potential inflationary problems that come with that. So gold is one to watch. Certainly, if you're looking at doing some trading, that would be an area to be. Copper, I bring this chart up from time to time. It's been in a tremendous downturn since the start of the year and when the COVID crisis hit us. We actually see our first row of X's. I traditionally will look at this chart in a 3% mode. I did go to a 2%, so this column of X's would not show up in a 3%, but I thought it was material. This is a first sign of any reversal in copper, which quite often is seen as an economic barometer. So it is somewhat positive, again, coming off grossly oversold levels, but we'll watch this chart. That 230 range, if we can get up into the mid 250s, could potentially be positive for it. But again, at this moment in time, we would just consider this to be more of a bear market bounce. With that, I'm going to turn it over to Ted, and he's going to talk a little bit about what SIA Wealth can do and how to position it with your clients.
Thanks, Jeremy, and hi everyone. Thanks for joining us again. I'll be pretty brief here, but I will remind anyone, if anyone has any questions, feel free to ask. Type in the question onto the question tab. Again, some of the similarities from last week and last couple of weeks, and this is the biggest question we get: where will markets go from here? And again, there's two scenarios. As markets continue to go up, and that's the hope. And everything can get sorted out and we can get back to some level of normalcy. But the reality is I have to prepare for the worst, that this is a bit of a bear market rally, and we're going to see a second leg down. So if that's the situation, we're looking at two different scenarios. Again, it's a hope for the best, prepare for the worst, but we have to try and get as much context as possible. So on the next slide, we actually built quite an interesting slide that shows our equity action call during the 2008 crisis, which was interesting because if you look at this right now, when we went into our red zone, which is January 2008, over the subsequent few months, we had a 24% gain in the TSX from January to June's peak, which eventually led to a 50% drawdown. And as you can see from this, we've color-coded it to the SIA Charts equity action call, that the market movement up was strong enough to push us from the red zone into the yellow zone. And anecdotally, we did have some calls from advisors asking if this was a good time to re-enter the market. The problem is we don't know. Now, history doesn't repeat itself, but it does rhyme. So what we all want to do is, again, prepare for any type of down situation, prepare for any type of worsening over the next few months, because what happens is you could get the next few months of strong performance numbers. We could be pushed higher and higher, and that's fantastic. But the reality is, does the economic issues that we're seeing resulting from the COVID, resulting from 10 years of easy monetary policy, will that come home to roost at some point? And I think a lot of people are worried about that. So if that's the case, this opportunity to see some strength in the markets does become an opportunity to build this tactical sleeve that we at SIA keep on talking about. What we're trying to mention with this is to say, look, it's okay right now if you've been exposed to equity markets, you've gone down, you've come back up, you might even start to recoup some of the losses that you experienced in March, but that should be an opportunity maybe to rebalance and maybe to build a tactical sleeve using something like the funds that we run with BMO to tactically allow you to shift out of equities and back into it when the timing's right. So if you go to the next slide, you'll have an idea. Again, sorry, this was one of the most popular slides from last presentation, because again, what we're trying to show is that if the markets did go down 30% in March, you need a 43% recovery to break even. However, the worst case scenario is if markets go through a typical bear market decline of 50%, you're going to need that 100% rise just to break even. So what we're trying to do is say, let's tactically manage those equity allocations in our portfolio, and prepare ourselves. Let's sell into some of the strength here and just prepare ourselves for the portfolios. In 12 months from now, once we get the full picture of the impact of the coronavirus, we can go fully into equities and if we want to. But right now, there's just so much uncertainty. So again, the next slide, you'll be familiar with this. Sorry, the next slide after this. You'll be familiar with this. Again, is to show what that 20% or that tactical sleeve means using some hedge funds, alternative funds, or even our tactical global equity and our North American funds. The point of this is to say, right now, we're reducing that equity exposure. A typical 60-40 client would still have 40% equity, but our 20% allocation would be right now outside of equities right now. When that situation changes and we're back in the green, that 20% automatically shifts. I've had numerous conversations with advisors, and you're going to be active across the portfolio, but let us take some of that tactical decision making, because it is emotional draining, having markets going up and down significantly over the last couple of weeks, to make sure you can allocate the entire portfolio. So I just wanted to reiterate that the allocation, the same thing works for a balanced fund here. This is positioning our asset allocation as a 25% weight, which basically shows you how we can, as we move through the red, yellow, and green zone, how your portfolios will be allocated. So it's a really interesting concept. We've seen a number of advisors take advantage of it, and especially during this period of time. I don't know what will happen over the next few months. But again, if history does rhyme, then we could see a nice rally over the next few months that potentially leads to a bigger decline if we get a bit more information about what's happening across the board. So basically, from our point of view, we just want to tell you to, again, hope for the best, but let's prepare for the worst, and that includes looking at some of the things that we've built with BMO. If there are any questions, I'm gonna wrap it up here, and more than happy to have the conversation with any advisor if they want to reach out to us. But in the meantime, we're all staying safe, which is nice, and hopefully we'll all beat this. If there's any other comments, I'm going to go through some of the questions, and then I'll have Jeremy give some answers. So in ZFN, in our North American fund, we're showing ultra short Canadian bonds. Why did we convert our US positions back into Canada? Jeremy, do you want to address this, or should I?
Yeah, great question. The reason why is that this mandate will, as well as the Canadian mandate and the global asset allocation mandate, will all hold Canadian currency when we're in a red zone. The global equity mandate will hold US dollars or other currencies that are available to look for some upside while sitting in short-term money market instruments. So that's why we did that. We did it effectively to get exposure. When we do the purchases, we can purchase in US dollars or in Canadian dollars, and of course our currency costs are quite low when we're trading here. So if you're looking for us to make calls on the currency, which it's about half and half with our clients who would like us to do that. If you want us to make those calls, the Tactical Global Equity Fund is certainly the one to go for. If you're looking for just a static, let's put everything in park mode, then you're looking for the asset allocation if you want a fixed income component, or the North American or Canadian equity funds, which will have that Canadian exposure when we're in the red zone.
Okay. Another question, if commodities rise, would any of your mandates own gold via ETFs that own physical gold? Just curious.
It gets a little bit trickier in a full prospectus product to own those products, but we do have the ability within our global equity to look at commodities if they're there, but commodities would have to be ranked in the top 2 asset classes for that to happen. And then subsequent to that, The underlying commodity ETF would have to be a physical. It couldn't be a derivative of any kind, because you can't take counterparty risk when you're running a full prospectus product. So it's going to depend on a number of situations if that's available to us. Quite often it doesn't come to fruition, but for sure commodities has to be in the top 2 asset classes before we can even look at it.
Another question, your algorithm is heavily influenced by fund flows, from what I understand. To what extent would volume, either implied or actual, influence the equity action call? And is there a meaningful or significant lag?
Yeah, volume isn't used in our analysis for the equity action call. It's not used anywhere in our system because we're looking at a tremendous amount of data, not just from today or yesterday's activity, but we actually look at data right back as long as our data streams are. And so in a lot of cases, that's 20 years to look at day by day through that whole process. So we do that every single day once we get the close to combine all that data into the analysis of the equity action call. It really comes when you're trying to understand the EAC, it's really about relationships. It's relationships between those equity asset classes and then the other commodities, currencies, bonds, and cash. What's the relationship where those money flows are going? We can see right now that, and if we go to our asset classes, I'm just going to shift down here. Right here, we've got currency on top and cash in second. So this is almost a very unique red equity action call from the standpoint that at the top part of it is very short-term fixed incomes. Currency is just measuring those denominated in other currencies other than Canadian and US dollars. Cash is just looking at the short-term money market of Canada and US, and then bonds looking at the longer term. So traditionally we would see bonds ranked a bit higher here, but if you look at the 4 alternative asset classes, only commodities has lagged, even though it's had a little slight movement up here. Maybe with continued strength, if we get that oil punch up, we get gold continuing its rally, we could see it move above the equity positions here. But again, equities, as they've rallied, is pushing down on the other side. So it's a combination of watching the money flows from all these. It's a very intense algorithm that we use to get this done, but volumes aren't used on it. So, but looking at it from your point of view, and that's why from time to time, I'll show those comparison charts as I did earlier, where I showed our equal weight index 900, that market equal weight index versus our cash benchmark. That's really showing you the relative performance between the two. And even though equities have rallied, they really haven't done so on a broad basis. So, you know, watching a benchmark like the S&P 500 or the S&P TSX Composite is really not a great way to try to figure out what the underlying markets are going to do. Certainly, that's going to create emotion with your clients and maybe even emotion with yourselves, and certainly the talking heads on television. But the reality is we're always looking at that underlying. It's more important what's happening in the breadth of the market, and that's what these 7 asset classes are doing for us.
So I guess I misread the question, but I think instead of volume, the question was about volatility. So either implied or actual volatility, does that influence the equity action call, and is there a meaningful or significant lag?
Yeah, so I mean, that's again, if it's those comparison charts that we're doing, you know, visually, if I'm going to, I'll just pull down to this one here. It's more complex than this, but if you want to get it, so if you've got a situation where equities are up 5% and you've got, you know, if I was doing bonds and bonds were down 3%, you would have an 8% differential between them. That's going to be very important, and that volatility in here could see this thing swing very, very rapidly. So we've seen with our equity action call, at times it comes back very fast and other times it's slower. That's to do with that volatility. The more volatile, the more significant the change is between the relationships, the faster the equity action call will change.
Okay. Historically, election years have been good for equity markets. Thoughts on this year?
Well, it reminds me a lot more of 2008 than it does of previous years. Yes, certainly I guess, lack of a better word, seasonality of election cycles has traditionally been good, as the president generally is going to put their best foot forward in an election year. The COVID crisis really was a problem, but it actually just opened the wounds of other issues that were in the market, within crude, within leverage, within the marketplace. So we're really battling all of these, you know, the COVID, we're battling interest rate policy, debt policy, government debt policy has certainly changed, and obviously the oversupply of crude globally. These are all being fought at the same time. So this reminds me more of 2008, where you've got a cascade of problems, and I would not expect the election cycle to play to fruition as it has in previous years, where it's been a very bullish year.
We did have a couple questions that were asked about a couple of the offering memorandum private pools that SIA Wealth runs and how active they've been in the yellow and red zones. More than happy to deal with that after the call, but just be assured that one of them, the tactical market rotation pool, has been holding up quite well, and it's just it was just an of interest point, but I'm more than happy to discuss offline with most of the people who are asking those questions. Jeremy, if you don't have anything else, I just want to say thanks everyone for listening in. We're going to continue to do these every Wednesday, and if you have any questions, feel free to reach out to anyone on our team.
Yeah, thanks everyone for taking time. And if we do see something material happen, we will do an update. It may be a recorded update and a bit shorter than our weekly Wednesday presentations, but we'll certainly get that information out to you very timely.
Thank you, everyone.